And Torsten, Slok, great to have you with us. I'd like to hand over the word to you for a financial outlook.
Thank you. So let me continue where Catherine Mann stopped her discussion about the economic outlook and talk about the outlook for financial markets. It is clear, as the question also pointed to here at the end, that there are a number of things going on in financial markets that warrant our attention and which seem inconsistent with what's going on in the economy. And to discuss this, I brought along a few charts here where I will, in the first chart here, talk about the main conclusions and how I look at things at the moment. So what is the case for the next 3 months? What are the things that are key risks to the near-term outlook? And it's very clear that the number one risk, of course, is that we are seeing more COVID cases. This is the case, of course, in the US. This is the case in Europe. This was also the case in the UK, that, of course, and several other European countries also went into a lockdown. So we've begun to see some slight improvement in the number of new cases, but it's clear that with this new strain, the B.1.1.7 from the UK, the strain from South Africa, is still creating a lot of problems in terms of getting the virus under control. The next issue that also is important in the next 3 months is the vaccine rollout. As we all know, and as we follow, all of us, how a different country is doing. In the US, we just vaccinated 1 million people yesterday. So that means that the data is now running a little bit faster in terms of vaccinations. But to get to herd immunity by the middle of this year, if that is that 80% of the population has either been exposed to or vaccinated against the virus, we need to see instead a vaccination rate which is about 3 million people every day. So in other words, if we at the moment are at a run rate of around 1 million and we need to get to 3 million, then we still need to see more acceleration in the number of people who get vaccinated. So it continues to be the case that this is a very, very important point in the near term, namely that we need to see a continued rollout that successfully gets the population inoculated. Finally, in the next few months, as we know, we just got on the 25th, 24th of December, it all came through the news that we now have $600 stimulus checks coming through. With results in the Georgia runoff, Biden has been now talking about that will be increasing from $600 to $2,000. So that does mean that in the near term, we not only have number 1 and 2, which are the negative news, we also have number 3, which is positive news, namely some economic stimulus. So that's all a little bit mixed bag of different things that are going on, but it's very clear that in the short term, the number one risk by far is still the virus. Most importantly, of course, for anyone with a longer horizon is then to look beyond the next 3 months. And if it beyond the next 3 months, the outlook looks much better. We have vaccines boosting job growth, maybe more fiscal stimulus coming. We will know on Thursday this week, Biden is going to talk about what he called $1 trillion package that will potentially also be supporting infrastructure, potentially more fiscal stimulus. And that's, of course, telling you that not only could the vaccine solve a lot of problems in the second half of this year, you could also get another fiscal boost in the second half of this year. Stock markets and home prices are near all-time highs, as we just talked about. That's, of course, also very important for consumption. Consumers see wealth effects going up. It's true that maybe in the US in particular, there are some distributional issues in terms of who owns stocks, even who owns homes. But at the end of the day, still historically, when you have seen wealth in the household sector go up, you also generally tend to see consumption go up, even though the increase might be smaller at the moment than it was, say, 10 or 20 years ago, because stock holdings and house ownership is more concentrated on fewer hands. It is still the case that stock markets higher and home price higher is something that supports also economic growth. Number 3 on my list here is significant pent-up consumer and capex demand once the virus is under control. One very important feature in particular for the US and Europe is that households throughout the last 9 months or so have been saving a lot of money simply because they could not go and travel and go to restaurants and on airlines and on hotels. And therefore, they saved a lot of money. That's why the amount of money in checking accounts in your banking account has gone up significantly in the last 9 months, which of course tells you that there's a lot of savings in the US specifically the amount of savings that have become in excess of what is normally saved in the household sector is roughly around $1.5 trillion, which is roughly around 10% of annual consumer spending. So that means that households have saved a lot of money that potentially could be used when the economy starts to reopen and when the virus is no longer a problem. Number 4 on my list is a lower dollar, is of course boosting U.S. exports and hence U.S. GDP. This is only more recently, so I understand the dollar the last few days has gone up, but over the last several months we've seen the dollar depreciate. Remember, as we know, when the dollar goes down or your exchange rate goes down, your exports go up. So that's, of course, very helpful also for GDP. And finally, of course, with that backdrop, it becomes important to think about, well, if things could get potentially a lot better in the second half of this year and going into next year, well, what is then the outlook for inflation? And this is getting a lot of attention in financial markets. Break-evens, meaning tips inflation expectations, have been going up, whereas real interest rates have been going down. So that's why people are now beginning to say, well, if inflation expectations are going up in markets, maybe we will see a lot more inflation in the future. But the issue is that we're not seeing actual inflation go up, and we're not seeing surveys of inflation expectations. When you ask the household sector, do you think inflation will be higher? The answer is generally no, I think inflation will be lower. So there's a discrepancy between market-based inflation expectations and household survey-based inflation expectations. But as I've written here, once the economy, once the economy does get to full capacity, we will see inflation, and the Fed at the moment thinks that this will be in 2023. So the bottom line of this is that, as I've written low, investment implications are the following. We will have low inflation, and we'll have a dovish Fed. As we also just spoke about in the economic outlook, dovish Fed, of course, means that the Fed will be very supportive for continuously saying we will keep interest rates low until 2023. We are not in a hurry to raise interest rates. And if that's the case, then the hunt for yield should continue. And the hunt for yield means investors that are faced with zero interest rates in the US, faced with negative interest rates in the euro area, negative interest rates in Japan, they will continue to hunt yield in investment-grade corporate bonds, in high-yield corporate bonds, in loans. The important difference in the corporate bond space is that loans are floating rate. So that means that if you do worry about rates going up, then loans are a little bit more attractive, which is why loans have been outperforming more recently, whereas both IG and investment grade and high yield are locked in fixed rates. So that has therefore been a little bit more vulnerable from that perspective if you worry about rates going up. But the bottom line is that the hunt for yield, of course, also ultimately means that the stock market should be benefiting as long as short-term interest rates are low and as long as long-term interest rates are not going up too quickly and too dramatically from the still very, very low historical levels. So that's why the last thing I will talk about in the presentation is the key risks to this view, namely, what are the key risks to the hunt for yield regime? And the key risks are very simple. Higher rates, meaning higher long-term interest rates. They've been going up a little bit in the last few weeks. This is getting a lot of attention. This could continue to be a risk. If you do see interest rates go up a lot faster, the stock market would become more vulnerable. Another risk is the repeat of the 2013 taper tantrum. I'll talk about what that is exactly in a minute. But that basically means, remember in 2013, after the financial crisis, the Federal Reserve had interest rates from 2009 to 2013 at very, very low levels. And then Bernanke, the chair of the Federal Reserve at the time, said, well, maybe we do not need to buy as many treasuries after these 4 or 5 years of significant purchases. And this sentence that he said, maybe we do not need to be so extremely dovish and buy so much in treasuries. That sentence pushed long-term interest rates up more than 1 percentage point. So this is why this has nothing to do with inflation going up, had nothing to do with GDP accelerating, but only had something to do with the Fed changing communication. And that scenario of 2013 is very similar to what we see today, where the Fed, of course, is very dovish. They're very, very clearly saying we do not expect we should raise interest rates before 2023. And any change in tone from the Federal Reserve could potentially be the same risk, the so-called taper tantrum that we saw in 2013. So I'll show you a chart about that in just 1 minute. Another risk, of course, is Treasury auctions. Remember, the U.S. is running big fiscal deficits. When you run a big fiscal deficit as a country, you need to basically have someone buy your government bonds. And the Treasury auctions is the first place where we would begin to see stresses in government bond markets. So we're monitoring this very, very carefully, and I would recommend everyone to keep an eye on what's going on in Treasury auctions, because this is the first place to see any signs of whether there is enough demand for U.S. government bonds compared to how much supply is coming, in particular, again, if Biden does yet another trillion fiscal stimulus package. Finally, too high valuations. We just spoke about that. And of course, also very importantly, a lower dollar. Remember, 40% of U.S. stock market is held by foreigners. About a third of U.S. treasuries is held by foreigners. And about a third of U.S. corporate bonds is held by foreigners. So that's why U.S. financial markets are heavily influenced and impacted by foreigners. So that means that if the dollar does start to go down significantly from where we are today, in addition to what we already have seen, then this will also become a risk to the downside. So let me just show you a few pictures that backs this up and shows what the analysis is to get to those conclusions. This shows you in all bonds in the world, you can look at what interest rates are we looking at. And if you take the whole global bond market and look at what is the level of interest rates and how many bonds are trading at different levels of interest rates, you can see here, for example, as I've written in the title, 80% of global bonds in the world trade at less than 2% yield. So that's really an eye-opening number because it tells you that there is a lot of bonds out there that do not pay a lot in terms of interest. So this is, of course, why the hunt for yield is really exemplified and illustrated by this chart here that shows you very clearly that there's a lot of people who basically are saying 2% is not much in return for me. And I see inflation in my country, wherever I live, at 2%. And if that's the case, that means that the real return is zero. I need to hunt some yield. And therefore, I think many investors, and here I'm talking about pension funds, insurance companies, sovereign wealth funds, endowments, are, of course, looking at this chart and saying, I'm not willing to get paid 2% or less. And if I do have to get some more returns, I do need to hunt yield. And of course, that's what we have seen going on in financial markets. And the risk to that is, again, that if the risk-free rate goes up, then we could see more risk to risky assets. In other words, if long-term interest rates go up too quickly, we could see more risk to the stock market. This chart here shows you what happened to 10-year interest rates in the U.S. in 2013. Then Bernanke in May began to talk about that they would begin to slow their purchases of U.S. treasuries. This pushed 10-year rates in the U.S. up by 1.4%. So that's, of course, a very significant increase. And as I mentioned, this is the fear you can have today, that this is also what would be happening. Now, you could then say, well, why should interest rates go up? What is the argument for interest rates moving higher in this current situation? Well, this chart here illustrates how extremely low interest rates still are today. The blue line here is 10-year interest rates in the U.S., and the green line is the ISM manufacturing index. Remember, the ISM manufacturing index is a very good measure of the business cycle in the U.S. economy. And historically, we have seen some nice correlation between the economy in the green line and what interest rates do in the blue line. And have a look at where we are today. In the green line, the economy is actually really good, in particular in manufacturing, much better than what interest rates are suggesting. And you can see the question here that you immediately ask yourself when you see this chart is, why are interest rates still so low when you have that the manufacturing ISM has been going up so quickly from the manufacturing sector? So this is important. Manufacturing sector, of course, is different from the service sector. This hit with the virus did hit the service sector harder because, remember, restaurants, everything that's face-to-face, which is a service, was, of course, where the employment declines generally came along. But the bottom line here to this issue is that the economy is doing reasonably well relative to how low interest rates are. So this issue of thinking about what long-term interest rates will do, they're now 10-year rates in the U.S. are around 1%. This is not just some academic exercise where people say, oh, people always say interest rates will go up. This chart here is very clearly telling you that interest rates are very, very low, not only by historical standards, but also compared to where the economy is today. And the reason for that, of course, is what I have written here in the title, namely that the Federal Reserve, by both holding interest rates down and by purchasing $80 billion in treasuries every single month, the Federal Reserve is doing everything in their power to hold interest rates low, not only in the front end of the yield curve, but also further out the yield curve. And you might now ask, well, why is the Federal Reserve so keen on holding interest rates down? Well, the Federal Reserve has spoken very clearly about the virus and said, as long as there is a virus, we will do everything in our power to support the economy. And the best thing that the Federal Reserve can do, and this is the same thing from the ECB, this is the same thing from the Norwegian Central Bank, the Danish Central Bank, all around the world, all central banks are essentially doing the same thing, namely trying to be as supportive as they can while we have the pandemic. So that's why when the pandemic is here, it is not a surprise that the blue line is very depressed. But once the pandemic is over, once we no longer need all this support to government bond markets everywhere in Europe, also in the US and around the world, then you would expect that the blue line would begin to go up, and therefore the long-term interest rates will begin to go up. I know that it's difficult to see today because we are also worried about the virus still, and we are worried about the new strain, and we're worried about the number of cases still being very high. But as a long-term investor, I do think that it is very important to have a little bit longer horizon, try to think about what is the world going to look like in 6 months, in 12 months, and several years down the road. And I think that we can, at least now with the vaccine news being so promising, it is quite clear that we will have a very different situation later this year, and particularly going into next year, where the level of interest rates is no longer going to get this very significant support from the Federal Reserve that we're seeing at the moment. So in summary, if we both get fiscal stimulus, which is what Biden has been talking about now, more trillion-dollar packages, and we also get that monetary policy in the Federal Reserve, the ECB, Norris Bank begins to think about what do we want to do with interest rates when the economy is getting more normal, then the risk to interest rates at the moment continue to be to the upside. The final chart I want to show you is then what I mentioned also in the beginning, that, okay, while we wait for the economy to get better, then the hunt for yield or buying more risky assets is still a good strategy. What this chart shows you is the risk spectrum. Over here, you have the safest asset in the world. You have the Fed funds rate. If you don't feel that you get enough return in the Fed funds rate, you can start to buy a 10-year government bond, 10-year treasuries. And that, of course, at the moment also give a relatively low return at only 1%. These two assets over here are in your finance textbook, risk-free assets. So that's important that once you leave these two assets and begin to buy investment-grade credit or high-yield credit, then you begin to buy risky assets that suddenly have credit risk. So there's a very, very important wall that is very different between these assets here that are risk-free assets and these assets over here that are risky assets. And what investors have been doing now that the Federal Reserve has been so keen on holding risk-free rates down is that they've been chasing yield in investment-grade credit, in mortgages, securitized credit cards, securitized auto loans, in high-yield bonds. And if the returns you got in that were too low, of course, you could begin to talk about maybe I should be buying dividend-paying stocks in the S&P 500. Maybe I should be buying ESG, which was also a good idea. Maybe I should be buying more thematic ideas like artificial intelligence. Maybe I should be buying the middle-income consumer in emerging markets. And there's a lot of reasons why you could still be buying the stock market, because the stock market is now giving you more return in many ways than what you got over here in some of these other fixed income assets. And of course, if you wanted a lot more return and you wanted to take a lot more risk, of course, you could be buying emerging market stocks, emerging market credit, emerging market bonds on the government side, which of course would have more risk, even more risk associated with it. The issue in this chart here is that this begs the question, okay, if this is what's going on at the moment, that people are chasing yield to the right, what are the events that could reverse the ongoing hunt for yield? And the number one thing, of course, that could reverse the ongoing hunt for yield is inflation. And why is that inflation issue so important? Because if we do get inflation, the risk-free rate will go up. And if the risk-free rate goes up over here, then people will start to ask questions, why is it that I'm buying risky assets if I suddenly can get the risk-free rate at a higher level? So that's why inflation is by far the most important risk. I do not expect that we will have an inflation problem anytime soon. This is not what the Fed expects. This is not what the consensus expects. But nevertheless, this is a very important point to continue to monitor. One argument why we could see inflation is the dollar is going down. If the dollar does continue to go down, that could provide upward push on inflation and therefore could become a risk to risky assets. But watching inflation is very important. The dollar going down, as I mentioned earlier, is also very important because a lot of risky assets are held by foreigners. So therefore, as I mentioned, if the dollar is going down, foreigners might begin to ask, what are the risks associated with the dollar going down and therefore associated with these assets that I'm holding in US dollar-based terms? Tailing Treasury auctions is another way of saying what I said earlier, namely Treasury auctions also plays a role, that if there is less demand for US Treasuries and there's a significant increase in supply because of fiscal deficits pushing supply up repeatedly, then we will also, of course, have a situation where Treasury auctions could begin to push 10-year rates and government bond rates up in the US, which again will open up a debate among asset investors in credit and equities and emerging markets, asking, well, why am I buying these assets if I can suddenly get a higher return in Treasury rates themselves? Sudden change in market sentiment and valuations. We discuss this all the time, of course, with the stock market. As Siri just asked Catherine Mann about, the stock market does appear expensive when you look at the PE ratio, and it's certainly clear that it's at very, very high levels historically. And if we do have suddenly a change of how we look at it, from a number of different reasons could be coming around, then of course valuations could certainly also become an issue again for stock market valuations and even for corporate bond valuations, where corporate bond spreads, of course, are very tight, both on investment grade and high yield. Finally, financial instability. I know this sounds like, what does that mean? That's a very broad concept. But financial stability, of course, is something that regulators are very worried about. And financial stability is about whether institutions in the financial system, whether markets in the financial system are functioning. Are there any signs of stresses, just like we saw in 2020 in March, where all these risks came along? So the main conclusion here is, yes, we do believe, and I do think that there is a good reason to continue to hunt yield in risky assets, and I do appreciate that valuations are very, very high. But there are a number of things, at least 5 things here, that I think are very important to monitor for whether I should start to think about hunting less risk and going back to thinking about what are the other options. And there's, of course, also other options outside of this framework. This is all liquid assets, alternatives, and everything that has to do, again, with thematic investing in impact funds, ESG, various forms of real estate, non-liquid assets, which, of course, is what we do in Apollo, of course, is also extremely attractive when you think about the risks to liquid assets that continue to be more vulnerable to 10-year rates going up in an environment where the sentiment might be changing relatively quickly. But the main conclusion is, yes, the hunt for yield continues to be a very important driver of financial markets, and I do expect this to happen in a relatively orderly way over the coming quarters and also going into next year. But the risk to that benign view of long rates slowly moving higher, the stock market still doing reasonably well, credit spreads also still doing reasonably well. The risk to that is to keep an eye on these vulnerabilities in the system, namely these 5 things that I have listed here. So with that, let me stop there, Siri, and turn it back to you.
Thank you so much, Torsten, for giving us that presentation. And Torsten, you are Danish, but you've lived in the US for some 20 years. And it's hard to forget the pictures we saw from Washington last week, with supporters of Trump breaking into Congress and stock markets not being affected. How do you explain that? You've lived in Washington.
I know it is difficult to understand at many levels, and it's clear that one could describe this as a version of some political instability and institutional stresses, where it does, with those pictures in mind, it does open up a lot of questions about what the future, generally speaking, looks like. That being said, when you think about financial markets are trying to price different assets and price different equities, different bonds today based on future cash flows. So what the complicated issue is with the things that are going on politically, not only in the US, but globally in many countries, you have had over the last many years a number of significant changes where it is clear that investors are having a hard time trying to quantify what does that mean for the future cash flow for companies? What does that mean for the credit risk associated with different government bonds? In many cases, these answers to these questions have been addressed by the central banks. We have seen the Federal Reserve, of course, aggressively support the economy over the last 9 months. We've seen the ECB aggressively support the financial market over the last 9 months. So in some ways, the central bank actions have been distorting financial markets, have been distorting the way that we look at different events on the political front. And maybe investors have now been lulled into an understanding and a view that the central banks will always be there to help. The central banks will always be supporting because they're not willing to have financial stability, because financial instability, it comes with significant downside risk to the economy. So I'm not saying that the central banks are the only driver of financial markets and have been for the last 9 months. Certainly fundamentals have also gotten better. But what I am saying is that the central banks more broadly have played a more and more important role, as we also just saw in terms of the level of government bonds. In particular in the US, where the Federal Reserve has been buying corporate bonds, has also been very supportive for corporate bond markets and therefore for spread on investment grade credit on loans and high yields and everything, mortgages, that is a spread product that trades on top of treasuries. So that's why I think that financial markets are having some challenges figuring out when should I buy what the Fed is buying and the ECB is buying, and when should I step away from that and look at political events, look at other events, look at geopolitical events, and begin to worry about maybe those risks potentially being more important as drivers of financial markets. So the answer to your question, in my view, is that yes, it does open up a lot of issues in terms of what might be coming down the road, including, of course, on the political front. But broadly speaking, financial markets have been getting so much support and continue to get so much support. Remember, the Federal Reserve is buying 80 billion in treasuries every single month. That's still a lot of support, and therefore something that does provide still very critical support to financial markets, independently of what's happening on the political, geopolitical, and all other fronts in financial markets.
And then a topic we haven't touched much on today, oil prices. And the oil prices have been low during the pandemic. What will happen when the world starts moving again?
Yeah, this is very important. As we all know, we saw in the spring of last year that oil prices, to everyone's surprise, were zero, and they were briefly negative. The reason why that happened, of course, was that the global economy was extremely weak. We saw a very significant decline in production in companies. We saw a very significant decline in energy use when people suddenly stayed at home in March and April and didn't go out and didn't even drive out in your car and our cars at the time. And when there's much less demand from households for energy, when there's much less demand from companies for energy, that of course means that oil prices begin to go down. And as we saw, of course, oil prices really came down very substantially. So I would expect with the same logic that once we do begin to see the vaccine come along in the next few months, once we do begin to see the global economy come back, I do understand, and there's a lot of discussions, of course, we can have around which countries come back first. But I do generally think that if in the second half of this year, the global economy and therefore more people will be coming back to normal, that means more factories will be producing more goods and services. We'll see more people driving on the roads. We'll generally see more traffic, more air traffic. All of that should also be pushing oil prices higher simply because demand will be coming back. So I would say that the answer to your question is when the economy was weak, there was very little demand for energy and therefore oil prices were under heavy downward pressure. And when the global economy now is expected to come back, and that's not only me having that view, this is a consensus view, this is the Federal Reserve, this is the ECB. I used to work at the IMF and at the OECD, and both those institutions are saying we will get significant growth in the second half of this year and going into next year. And associated with that, I would expect to see potentially quite a significant jump in oil prices. I know there's still a lot of structural headwinds in energy coming from renewables, from solar panels, coming from windmills, everything that goes into the various discussions we have around ESG. But I still think that the business cycle of the economy getting better, despite these headwinds from a transformation away from fossil fuels towards renewable energy, I still think that oil prices are in for quite a significant increase as we go through this year.
Final question from viewers, Torsten, and I'd like you to answer briefly on this one. But investing sustainably has become more mainstream during the pandemic and very popular. And what is the risk? Do you see any risk there?
So, and it makes sense because there are a lot of very good reasons to invest in ESG and sustainable investing. The risk, of course, is that when you sometimes look at the baskets of public companies that say that they are green, and in many ways they are green, but you look at the names of the companies that are in your ESG basket, you do lean back in your chair sometimes and say, is that what I thought I would have invested in if I said I was going to buy an ESG company? When we talk about and think about ESG, at least I generally think about clean tech. We think about things that help the environment, things that pollute less, things that are helpful in terms of creating a sustainable future for all of us. But then some of the names that are in some of the ESG baskets that you generally look at, they are names that are more in the tech world where you say, well, that is not really someone who's doing anything to do clean tech or clean up pollution, but maybe it's someone who just have more green buildings or someone who does have, which is all very important. But I do think that the answer to your question, Siri, is that one should start looking at ESG and thinking about what I want to invest in. I think it is very important and it absolutely is critical to do your homework and talk about, okay, but what is it exactly that I'm investing in? And is this thing that I'm investing in, is that really an ESG investment, or is it just a tech investment, or is it just another investment which ends up in a financial, which end up being much more vulnerable to a lot of other things relative to the story that I just want to buy something that is ESG and sustainable investing.
Thank you so much, Torsten Slok, with us from New York.